And if life expectancy keeps increasing, to buy an annuity at age 65, you've got 20 years of income in theory there.
What is the point of an annuity? With rising interest rates, they've gained popularity recently, but are they really worth it? Mark Ormston works for one of the top annuities brokers in the UK, Retirement Line.
When is the right time? When does the rate match with the wants and needs? It's a gamble. It's a bet against life expectancy.
People die.
Yeah, that's exactly it.
Yeah.
I mean, it feels awkward, but that's what an annuity is.
I'll be blunt, I'm quite surprised that you're dashing man. I was like, oh, here we go, the annuities is quite sexy. I was thinking this is going to be,
It's going to be boring.
Oh, no, right. So we've got annuities, local government. I'm assuming this is 18 plus because it's going to get pretty hot and sweaty. It's going to get nice and sexy, isn't it? You know?
Yeah. But anyway, could we start with a big question then? So what even is an annuity?
Yeah, so an annuity is a financial product where you take a pot of money, typically pension funds, but it can be cash, and you give it to an annuity provider and they give you an income for the rest of your life and beyond, ... So in theory, you can tailor the product so it goes to a spouse, beneficiaries, partners, but people typically do it for their own lives.
Is it a form? Is it almost like an insurance or an assurance in a way of? It's like a guaranteed income. Is that right?
It's a guaranteed income, so it's all known from the outset. So when you're shopping around, you have to shop around. There's so many gaps and different offerings. So you go on the open market, shop around, get the best rate. But you have a look and goes, right, that's what I'm going to get, or that's what my partner's going to get for the rest of their life. Fixed, guaranteed, simple, in theory.
Is there you say it doesn't have to be a pension, it can be a pot of money.
Yeah.
So if you have 100 grand, you can put that into an annuity. Is there a minimum?
Yeah, so with pensions in particular, it's about £2,000 is the minimum. Just to give you an idea, average or the most popular sort of fund value to purchase an annuity is somewhere between 50,000 and 100,000. That's the most popular cohort.
And what sort of income are you getting? I mean, we'll go into all the rates in a minute, but right now, if I gave you £100,000, ballpark, what am I getting?
So for a 65-year-old, because that's the age that we love to use in pensions, for a 65-year-old, that's £7,700 a year for the rest of your life, and that's your base point. So that should be your starting point.
That's a 7% return. So that's relatively high on the basis that 100k might kick out 4k a year. Yeah. But is that 7k static?
That's 7,700 static. Mm-hmm. If you want it to have some sort of inflation protection, which you can do, so say if you went up 3% a year, that starts about £5,700 a year for a 65-year-old. So you really have to think, I think the problem with annuities are that you're really imbalancing your immediate needs, so that higher income that you need right now, against those future protections. So you don't know what that looks like, especially when you start thinking about death and inheritance and all these sort of points. It gets a bit tricky.
But I'm quite surprised that the headline rate initially is so high. I know it's linked to interest rates and we'll come into it in a minute, but if what I'm assuming is happening is an insurance company or an annuity provider takes the 100k, they go away and they invest that somewhere and they hope to generate a return above and beyond what they pay out. Yeah. So if they're giving 7%, they haven't got much room there to make a return.
No, but that's, like I say, we'll probably get into it in a little bit more depth, but what they're typically doing is they're investing in UK mid-term gilts, so 12-year, 15-year gilts. And if you go back to 2020-ish, that rate that I just said, that's 7.7%. That was about 5% back then. So there was a huge difference. And mid-term gilts were 0.5%. Today we're at 4.9%. So there's been a huge jump in recent years, and there's lots of reasons.
But none of those numbers are 7% that you just said.
No, none of them are 7%.
How are they getting the 7% if they're only getting 5?
So they're getting 5 from the gilts, then they're allowed to invest in other things as well. And of course, the other thing that they're doing is it's a gamble. It's a bet against life expectancy.
People die.
Yeah, that's exactly it. Yeah. I mean, it feels awkward, but that's what an annuity is. They're calculating your life expectancy, and then it's up to you to do that.
So there's basically a portion of the return they're basically saying, we know we can get 4%, 5% by basically sticking it in a bank account almost. Okay. We're going to take a stance that if we lend to 1 million people, that 10% of them are going to die early, and that produces a return for us essentially. Yeah, and we give a bit of that return to people in their annuity promise to get them through the door.
Yeah, 100%. That's exactly how it works. And I think the really important thing is because it's based on individuals' longevity, health and lifestyle information is so important. So when you think about your life insurance and you think about insurance products, typically you go, I've just run a marathon. I'm really sorry. I'm just slightly breathless because I've just done 30 miles, I've done a quick 5K. You want to come across really healthy. Whereas with your annuity provider, what you want to turn around and goes, oh my word, I'm so unfit. My BMI is unbelievable. I basically have half a bottle of wine a night.
70 cigarettes a day.
70 cigarettes a
Slotty
day.
annuities, mate. Yeah. They come in, a heavy smoker.
Can I call you back in 5 minutes? I'm so breathless just from having the conversation.
Wow.
That's the sort of thing that you want to get into. It's quite bizarre. So it's the exact opposite of your life insurance conversation.
So you shouldn't hide the aches and pains, the conditions, or the bad habits.
Exactly. Very important. So smoking, if you went 10 a day smoker, something like that, that's an increase of about 15% on that base rate that I just gave you of that 7.7. So there's a lot of money to be had.
It pays to smoke in that sense.
Finally, we're onto something.
Can you get an annuity right now?
With a chicken dinner. Do they check it, like, you know, if you're doing your insurance for your life insurance, they're like, okay, I don't smoke, and then they realize you're a smoker and you can't get your money. Yeah. Do they check that you actually do smoke or that you actually don't go to your gym? Like, I saw you in the gym. You said you don't even know where the gym is, you liar. So, do they actually?
They do, yeah. So will happen quite frequently, actually. It's about, I don't know if I should say the number, but about 1 in 3. They check about 1 in 3. So they'll go to the GP and go, this is the information we've provided. Can you validate it? Every so often there's an awkward conversation with the doctor and sort of said, I did tell you I gave up smoking. I am still smoking. And then they'll do a quick nicotine check and they'll confirm that they are smoking. So that will happen every so often. The other thing that's happened actually this year, it's quite funny. Husband was on the phone, quotes were produced, went away. Husband called back up in about 10 minutes when I'm really sorry, my wife was with me. I told her that I quit smoking. I am still smoking. Can you redo the figures for me? It's really quite bizarre because people are a little bit ashamed of these things.
A lot of people can relate to that. Like, you always try and put your best foot forward for people.
Yeah. And I think you also have some really difficult conversations. So many moons ago, I was an annuity specialist. I was helping people. It was before pension freedom. So basically most people were purchasing an annuity. A severe case of diabetes, there was insulin, there was amputation involved. It was a pot of about £20,000 and he was getting just over £5,000 a year. And you don't have to be very quick with the maths to go, oh.
They think you're going to die quite soon.
Yeah, exactly.
So what happens if you because it's meant to be guaranteed for the rest of your life. What if you live like 10 years and they thought you're going to live 4 years?
You win that gamble.
So you still get paid every year?
It's literally like taking a bet, isn't it? And you're the other side of the bet. Yeah. And if they come back, if you go, I've got 100 grand, they go, we'll give you 50 grand a year. They're basically saying you're dead in 2 years.
That's it.
So it's almost like, and I'm guessing you're pretty sophisticated in your assessment of life expectancy. You've got a lot of data points.
Loads of data points. And what's really important as well is its scoring system. So even if you go, okay, I'm just going to tell you I'm a little bit overweight, and then I'm taking a tablet for simvastatin or cholesterol, this sort of side of things. Most people do as they get older, even if they're preventative, they add up on the underwriting scoring. So very quickly, a couple of minor things still get you extra income, not just for 1 year, for every year for the rest of your life.
Yeah.
And this is what's quite important. You know, if it was me, maybe I'm going to start being a little bit more unhealthy, going up to retirement, get my annuity and then go on that massive health kick and outlast it. It's the way to
6
game
months
it.
before you go to your doctor, be like, I just can't put down the fags.
Just do all-nighters for like a year, just every night on it.
That's pretty good. The first year of retirement, just go hard.
Just go big.
Just go really big. But that is fascinating because it's so counterintuitive to what we all expect.
Yeah.
It's almost good to show them warts and all.
Yeah, it's so important because, like I say, it's individual. So ignore that initial sort of quote that I've given you. That should be your base point. Then get a quote for you and your health, your lifestyle, because that really matters.
Okay, you talked about the pension freedom legislation there. I believe it's 2014. Is that correct?
George Osborne stood up in 2014 and it came into effect 2015.
There we go. So he came out and he basically gave people more freedoms.
Yes.
Prior to that, did you have to buy an annuity with a defined contribution pension pot? Is that correct?
So you didn't absolutely have to. There was other options available, but all the frameworks very much made it quite tricky for you. So the vast majority, 90+% of people, were having to buy an annuity.
Why do you think they made that decision at the time, and do you think it was a good decision?
I'll do the second question first.
Yeah.
I think it was a good decision because who wants to be forced into a product they don't want? doesn't make any sense.
Especially because rates dropped and stuff after.
Yeah.
Like in hindsight, they became very not as valuable, did they? Pretty much straight after.
Yeah, straight after, because obviously, competition in the market fell away. So there was a lot fewer annuity providers in the market. So that impacts rates as well. I think the other main point is that they're buying really small annuities. I know people with an annuity paying £1 something a month. What can they do with that money? It wasn't working very well. So I think, one, it was a very good thing to do it because it gives people choice. It's their pension savings, it's their money. They should choose what they're going to do with it. I think that's a positive thing. Two, on the other side of the coin, it hasn't done too much harm to HMT. The Treasury and the taxman, the amount of income that they're picking up now is not a bad thing from a government point of view.
Because people ripping the money out of the pensions and it's getting taxed.
Exactly that.
Yeah. Do you think, though, there's an argument as well that they gave people too much control over? I mean, so coming from it from a different angle, I used to sell investment properties in a former life.
Yeah.
And I'd often encounter people where we were trying to sell them an off-plan development in Manchester, and they were like, "Oh no, I'm going to buy this parking space in Dubai," and that might have done okay, but I was like, "You're taking all the money out of your pension to buy a parking space in a foreign country, like that's." And I saw a lot of that, you know.
And you still get that in pensions now. You still get a fair few SIPs in these sort of investments, and people are taking a risk. There is that side of things. So if people are taking all of their pension pot, especially if they're still working, so it's that tax consequences. If you're still working, it's taxable income in that tax year. So even if, to some people, a modest pension of say 20,000, all of a sudden that's 25% tax free. That 15,000 is going to be taxable income that tax year. It's going to push a lot of people into a higher tax bracket for that year. That's something really worth considering. And then can they manage that money for the rest of their life? And this is why a lot of people like to go for an annuity, just purely because it's taking care of them. It's all done. I'm going to get X amount of income, like a salary, for the rest of my life, and it's done, sorted.
I think the one thing that has maybe become attractive to me, like you say, is it doesn't have to be everything. It can be a portion, and you could maybe say my fixed costs or the heating and the lights and the food is 10 grand a year. I'm going to get an annuity for that, and then the rest kind of reduces market risk and volatility within the portfolio.
I'm a huge fan of things like the PLSA retirement living standards.
Yeah.
So that minimum retirement living standard, if you're taking the full new state pension and you use 23,000 last time I looked of a pension pot to purchase an annuity with escalation, so 3% each year, so you've got a little bit of inflation
linked,
protection. Yeah, exactly.
Yeah.
Then that will get you that minimum retirement living standard for the rest of your life, guaranteed.
So you get state pension and a 20 grand pension pot to buy an annuity that grows by 3% a year, and that gives you the minimum.
As it currently is today.
20 grand.
Yeah.
So you're not talking big numbers. I thought you were going to come in and be like 200 grand, 300 grand, these kind of. So you think that people could go, they can kind of take a view if they haven't got much in pension savings and say, I can at least get some guarantee of quality of life that is inflation linked as well, which is big.
Yeah, it's so important because especially if you are accessing, and there's a big gap since pension freedom, so there's access point, which there's a lot of people accessing their pension, taking their tax-free cash at 55 to 60. And then there's the pension income stage, which is happening much later on in the journey, so 65 to 70, that you really need to start thinking about it and that flexibility. And if life expectancy keeps increasing, which is currently mid-80s, to buy an annuity at age 65, you've got 20 years of income in theory there. And what you're selecting at the age 65 to last for 20 years, it's a big decision. Those options that you're choosing, you need a crystal ball almost to get it right.
What age do most people buy annuities?
Yeah, so 65 is that popular age. There's a good sort of bit of industry thinking that you want to purchase an annuity a little bit later in life. That's because you're taking that pot of money and you're fixing it.
Because you're more likely to die sooner, so you guys make a bit more money.
Yeah.
Yeah, I was thinking.
Buy it when you're 89.
It's all commercial
Give us a
reasons.
meal. We'll sort you out for the rest of your life.
Yeah, it's all commercial reasons. I promise. No, it's because when you think about it, when you're a little bit younger, you want that flexibility. So you might want to access your pension pot. Hence why most people go into drawdown at that sort of age, because you've got the flexibility and there's a lot longer time there for investment exposure. When you're a little bit older, cognitive decline, things might be a little bit more settled. So a lot of people are looking at purchasing an annuity between 75 and 80.
Like care costs and things like this.
Yeah.
To cover those costs. Because The big question mark is how long do you live? Because like the care costs are so high. It's assuming you go into a care home, £800 a week, £1,000 a week. It's like, I might have enough money if I live for 5 years. I might not if for 10, or I might even live for 15 or 20. And no one wants to die, right? But I guess with an annuity, you could go, well, at least I know I can live in that care home forever, essentially.
Yeah, that's it. It's getting a known quantity of income. So whatever that income is, as long as you've got the funds to support it and the rates are there, you want to secure, lock it in, known, sorted. It's a weight off everyone's mind. And we were just discussing it before we started recording. Things are quite uncertain right now. So when things are uncertain, people look for certainty. That's what an annuity can provide.
Could I buy one at 40?
No, so it's minimum age 55 currently, moving to 57.
Okay, so it's tied to the access of pensions.
Correct.
So if you're a billionaire and you're just like, I just want to lock in a guaranteed income for life, you can't buy one at 40.
No, unless you've got those wonderful exemptions like you're a sports star and everything else.
So they can buy annuities?
Yeah, so they can access their pension earlier as well, for example.
How about a social media influencer?
I was about to say, what about YouTubers?
You're far too famous, you're not allowed.
I don't know about that. We've been looking for annuity, haven't we?
No.
Get rid of this guy. No, that's interesting with the footballers.
Yeah.
So they can access their pension sooner.
Yeah.
How much can they stick into a pension?
As much as they like. I mean, I can't for data protection reasons, but I know some very high-profile footballers with annuities that we've supported.
But I mean, like, you know, a footballer, you say they access their pension. Do they have pension rules outside of the ones we do as well? As in, they can pay more than 60k a year into a pension?
Oh, so no, from a tax point of view, they're the same, but the exemptions are very much on the access point, so they can access much younger.
Yeah, I just mean, because if they max it from 20 to 30, 60k a year, they can access it in their mid-30s. It's not going to be, they're going to spend all of that before they get to retirement.
Yeah, well, with an annuity, they can do that.
They keep going, Do a lot of footballers do that? It seems like a cheat code. Because if you're getting paid like a mil a week or $500,000 a week or something, then you're just like, I get an annuity, and then even if I break my leg or I retire, I'm set for the rest of my life.
Yeah, there's, like I say, we've had experience with footballers definitely going down that route, and you can understand why.
Yeah, of course. I mean, it's pretty sensible in a way. It's kind of, I don't think many footballers think like that, do they?
No, well, to be fair, this is a financial advisor on behalf of the footballer, which is slightly different.
Okay, yeah. How do you, I mean, how long do footballers live for? Like Ronaldinho is doing his best to just hit the dirt, isn't he?
What about Pele?
Yeah, exactly.
It depends on your lifestyle.
Yeah, or then you get like a James Milner who just like goes forever. Do you know what I mean? Like, you don't want to insure him.
Yeah, Milner will get in a much lower rate.
Yeah, you get quid a week, Milner.
He'll be struggling. He's not getting 5% a year. He's struggling.
He's like, I smoke 50 a day. Yeah. Like, you sure about that?
Maradona, that would have been very interesting to see where he would have been getting towards his later years. That would have been very different.
Yeah.
One of the goals of personal finance is to take the money that we earn and to put it to work, so that one day we can hopefully stop working. But I often speak to company owners who have got plenty of money, quite large sums of cash, just sat in their business bank account doing absolutely nothing. So why not at least put that money to work? This is why I'm happy that we're working with Tide. They offer an instant access saver which I use as an account to generate interest on excess money for things like tax savings. New members can earn up to 4.22% AER variable for up to 6 months. I say up to because it depends on how much you deposit in your account, and the more you save, the higher the rate. You can get this deal, plus you can get £100 cash back if you fund your Tide Instant Saver account with £5,000 in the first 30 days, if you use code MAKINGMONEY. T's and C's apply. The code is Making Money, all one word, or you can use the link in the description where you'll also find all of the offer and the full terms. The variable rate is correct as of the 8th of May 2025.
Okay, can we talk about the different types of annuity then? Because it's not just one type. From the research, I found that they're pretty complicated. There's a lot of different types.
Yeah. So high level, we've got the lifetime annuity. So when you've got the lifetime annuity, exactly what it says on the tin. You fix it in, that's for life. But then you've got all the options. So joint life, i.e. a percentage of that income goes to a spouse on death. So if it's me, I went joint life 100%. What I'm saying there is 100% of the income continues to my spouse in the event of my death. So you look at those sort of things.
So you could go 70%. So if I die,
Yep.
the partner gets 70% of the income.
Correct.
And that would make the annuity cheaper to buy because it's less cover, right?
Then 100%, correct.
Yeah. It's more expensive,
but more
cover.
expensive. Yeah, exactly. So you can do any percentage between literally 1 to 100.
1%.
Yeah.
You die.
Have a little taste. Have a touch.
Feels like you're sending a message at that point. Isn't it?
Can I do 0.1%? Is that an option?
But you know, it's so funny as well because most husbands that we go through, they go, no, she's fine, she's sorted.
She's sorted.
So many people. Yeah, I hear that.
What, if I die, she's all right?
Yeah, no, this is just for me. She's got the house, she's got all of this, it's fine.
Wow.
But whereas typically wives, when they get on the phone, like, oh no, I would like to secure a little bit in the event of an early death. Because that's one of the things that I think annuities can get a bad press for. I've locked in this set amount of income and I die after 2 years. That's a bad outcome. I've had 2 years of income. The rest of it's the annuity provider's kept. Right.
But that provides everyone else with the higher rate. Like the 7%.
Yeah, but you don't care about everyone else when it's your money.
This is what I'm, no, but
I mean, yeah, in theory,
I'm looking at it
but
from
if
like a
I've
whole
worked and
market.
I've given you like 200k and then I only get paid out like 20k for 2 years, and then you're like, oh, everyone else gets it. I'm like, yeah, but I
Should have
work
got a
for
few
the...
more steps in, shouldn't you? Do you know what I mean?
You went too large in that first year. You need to rein it back a little.
No, that's you, mate. I want to be part of his pool.
Yeah, Dave was like, I want it all if you...
Boost the average. No, but okay.
So you've got that sort of thing, but you can also do options where you protect the capital. So if I put £100,000 in, I can go for an option known as value protection. And if I die before I receive £100,000 back, the difference, so whatever it be, say if I've received £80,000 back, that £20,000 will be paid to the beneficiary or estate. So that just costs a little bit more. And the other thing, the most popular way of doing this is a guarantee period, which basically means it guarantees to pay out the income whether I'm alive or not. So very popular is a 5-year guarantee period, which means the annuity income will be paid out for 5 years whether I'm alive or not. And that's quite inexpensive. It might cost something in the region of a couple of pounds a month.
And then if you live for more than 5 years, you still get
still
your
get paid.
annuity is normal.
Yeah,
But your family will get it if you die within the
If you die, then your family get the rest.
Yeah.
Yeah, that's it. And because you can have a guarantee period between sort of 1 year and 30 years, while rates are where they're at, here's a little bit of another cheat code for you. Bless you.
Just trying to get the claim up.
Yeah, exactly.
Really sick.
I'm so poorly.
Sneezed at.
It's all on camera. I'm logging it all. Get a fag out, mate.
But you can get a guarantee period for a really long period of time. So I looked at a quote today, actually, so it's 15 years. So 15-year guarantee period. I've got a notepad here. 15-year guarantee period. Rate was, for 65-year-olds, 7.3%. Okay? That's guaranteeing to pay out 109,000, whether I'm alive or not. So if I live beyond those 15 years, I'm still getting my £7,000 a year guaranteed. If I haven't, I've at least covered what I put in plus a little bit more for the estate.
And there's like whole life and then there's terms, right?
Yeah.
So you could be like, I just want it for 10 years or...
Yeah. So fixed term annuities, I really like this product. Don't think a lot of people are fully aware of this product, but people tend to use it in one of two ways. So the first way is, I like guarantees, I like security. However, I don't want to lock in for life. I'm just not ready for that. So what you can do is take a fixed term annuity, anywhere between 3 years and 20 years. I think it might actually be 25 years. And just say, okay, I want a set amount of income for this period of time. And if there's enough left over, the annuity provider says, this amount is guaranteed to be returned to you at the end of that term. So again, I've just, so we've got some up-to-date figures or all change. But if I said, okay, I've got £100,000, I would like about the same as a lifetime annuity, a little bit more. So give me £8,000 a year for 5 years. I get my £8,000 for 5 years. At the end of the 5th year, the annuity provider, the best annuity provider I saw, was going to return just over £82,000 to me. So over that 5-year period, the total return is about 123,000. So that's a really nice way of people getting that security through the guaranteed element of the annuity. But what this product gives you, which the lifetime product doesn't give you, is some investment return and some flexibility. So I could break out of the fixed term product. I can't out of a lifetime product. So it gives you a lot more flexibility than that lifetime product.
If you break out, I assume you've got penalties.
So what they do is they recalculate on rates at that time.
Okay.
So you're likely to lose a little bit, but everything I've seen is hundreds of pounds difference, not thousands of pounds difference. So it is quite worth having a look. And the other way people are using it is as a bridging pension. So what I see
From
quite a
55
lot.
to state or whatever.
Yeah,
or like if you're in the NHS and you've got like a DB scheme.
Exactly. So a lot of people say, oh, I've got this small workplace schemes, whatever it is. I want to reduce my hours. I'm 63 now, very popular age fixed to do this. I'm 63 now, and I just want something to stop working or reduce my hours until my state pension kicks in. So I'm looking for this £10,000-ish a year, and then my state pension will take over. So it enables people to sort their life out, actually retire a little bit earlier, reduce hours, or stop working altogether. It's a really nice way of doing it. And then their DB pension will kick in as well, which is something that the cohort of retirees we're seeing this generation, next generation, can take full advantage of.
Yeah.
When we get there, I don't know if we're going to be relying on our final salary pensions quite so much. So it'll be slightly
Like
different.
more DC schemes.
Exactly.
Yeah. And then there's also, so Paul Todd, who we had on, who is the head of investment at Nest, he talked about deferred annuities.
Yeah.
So this is the idea of, I'll have it in the future.
Yeah.
So what's this product and how might that be useful?
Yeah, so deferred annuities are fantastic in theory. They seem to make an awful lot of sense. It goes into what I was saying earlier. So you want an annuity a little bit later in life when that uncertainty grows and grows and grows, and the rates increase, because the older you get, the closer you are to death. Cheery subject, I know. But you're going to get higher income that way. So what they do is they say, right, we're going to put away a proportion of money now, or we're going to drip feed a bit of money in, and then we're going to buy an annuity at a set point in time to try and stop you running out of money, in essence. Because that's the danger of drawdown, is you keep withdrawing, the investment return isn't quite where you want it to be. Oh no, I'm 85 and I'm still alive and I've got no money, other than relying on the state. That's not very comfortable for anyone. So what it does is say, right, at this point in time, we're going to take this pot of money and purchase an annuity for you, so you've got that later life security. So it works well. What I would say is, if you're locking into a rate 10 years before you get it, you're taking a gamble. You don't know what rate's going to be. And as I said earlier, health-wise, if you're in much poorer health at the age of 80 than you were when you were 65, are you getting the best rate? So that's something really for these designs to think about, because they don't want to give poor value for money if you can just buy an annuity live at that time and get a better rate.
Yeah, you could have waited and they'd be like, okay, well, you're very ill now. In your 60s, you might look great.
Exactly.
You got a better, worse rate. But at the same time, I do see this benefit of going, my care's taken care of. I'm just going to spend my money now. You know?
And that's what I'm saying. Some people really do just like certainty. This is where the product comes into its own. There's no other product out there that can guarantee like an annuity. I take issue when people say it's risk-free, because nothing's risk-free, because ultimately you're locking away quite a large sum of money typically, and that's it for life. You could die, you could not die. You know, all these factors are unknown. There's so much unknown in that long period of time. Whereas, you know, the thing that you are locking into is basically the rate. It's just the income. That's what you get locking into for life. Everything else is still uncontrollable.
Well, in terms of the risk, then, what about the risk of the annuity provider going under over the time period? And what happens there? What protections are there for people if you go bust? Or you're a broker, aren't you? Sorry. People that you refer to.
Yeah, so they're all the standard financial services compensation scheme, 100% protection
up
there.
to 85k, is that then?
Yeah, it's up to the 85,000, but typically, like I say, they're always going to pay out with the annuity. There's going to be no concerns there. I've not had an annuity provider go bust in our time.
You've not had one go bust?
No.
Like, would you know, let's say I've got £1 million to put into an annuity, would it make sense then to spread it across 10 different providers? Or?
No. So that even under the FSCS, I know the investment limits 85,000, but the annuity income's always 100% protected.
Oh, so your income is protected.
Correct.
Okay.
Yeah.
So just to be clear, like the income is in the amount that you were promised, you will get that under the financial services compensation
Correct.
scheme.
Yeah.
If the annuity provider goes bust.
Correct. Yeah.
That's awesome.
That's interesting. Yeah. What about the ones where there's lump sums at the end though, and they're promised back? Will they?
Yeah, that's the same. So that one's under drawdown rules. So that one falls much more into the 85,000 category, whereas the lifetime, it's the income that's being protected.
Yeah, I guess it's kind of, you can't just say to someone, "Oh well, sorry," you know, like that doesn't. You're not getting that. Like, here's your 85k, and it's like I gave him 2 million quid, and that was my whole retirement. You know, it's. Yeah, exactly. I guess you can't turn your back on people at that point.
No, especially again, older cohorts of people, isn't it? This is what they're relying on. Typically they've stopped working. They're not going to go and get work again.
But you find that annuity providers don't go bust.
I've generally. Never, not in my experience. No.
And who are they? Are they big insurers? Are they like Zurich and people like that? Or are they specialised annuity companies?
No, so there's a couple of specialist ones, but typically it's all the people, you know, it's your Legal & Generals, your Avivas. It's all your household names, but you've got specialist ones like Just. So Just are quite a competitive annuity provider, and quite often you'll get people go, who are Just? Not heard of Just. Is
Zurich even an insurer, or did I just make that up?
It's a country in Switzerland. It's a city in Switzerland.
I swear that's like an insurer. I'm just saying
they do UK insurance.
See, I knew it. Don't worry about it.
But yeah, no, they're not an annuity provider. Yeah,
they're not an annuity provider.
No.
Oh, okay. I was just like, I don't know why they sprung to my head, but yeah. So these are big institutional insurers.
They're all the people. So typically, like I say, all the people that you think about for your home insurance, your life insurance, your car insurance, they're mainly on the panel.
Okay, perfect. And I think another thing that we want to talk about is probably the fees that are involved. Yeah. So we talked about the risk and they take the other side of the deal, but they take fees, don't they? So obviously that's tempering some of that risk on their side. They're
all factored into the price. So this is the difficult thing. When you're going into, say, drawdown or investments, you see that annual cost and it's there, it's quite clear, it's transparent. Whereas with the annuity, it's not there. It's all just wrapped up. And you don't truly know what they're investing in. So you don't see, they've made X on my fund value. You don't really get to see that. And typically, because you're dead, you don't really care at that point to do that calculation. So that's a bit of a difficulty. What I would say is, because, as I said, go and speak to annuity brokers, make sure you shop around on the open market. They typically get a percentage of the fund value that's being used to purchase the annuity. So really check out those costs, whether they're an advisor fee or a commission. Check them out, because I've seen some commission payments of 5% of the net fund value or the purchase price, which is, that would be a red light for me. I wouldn't go near that. Expect something between 1.5 and 3%.
And who's getting that? The broker?
The broker would get that. And that would be coming off from the annuity income typically. So when you're going for advice, it might come off the pension fund. So you might be charged 1%, and 1% will be taken off the pension fund, and then you're starting with a slightly lower fund value. Whereas with commission, that tends to come off the annuity income. So if that commission was lower, your annual income would be higher. So if you were purchasing an annuity with £100,000, if the commission was 1%, so that's £1,000 that annuity broker is going to receive. It's 3%, £3,000, and that's taken off the annuity rate. Whereas if you were doing it through advice, actually in the 1% example, £99,000 would go in to purchase the annuity, or £97,000 would go in to purchase the annuity. So again, it impacts the annuity income you're receiving, right? Because you're either starting with lower, or they're taking a little percentage off or a little bit off your income to pay the commission to the annuity broker. So it balances out, but they're the two ways that the costs are there.
If you die sooner, if you die sooner in that example, do they get less money then?
No clawback.
If you live longer, do they get more money?
No. So
will at some point then will the income kick up slightly because you paid the fees? Or
no, it's completely set. So it's all done from the outset.
Right. Okay.
So just watch out for that when people get annuity quotes.
Is there like a compare the market for annuity providers, or do they go and talk to a broker like you? Because brokers have fees as well, right? How do you compare lots of different providers?
Yeah, so there's lots of annuity brokers out there. Naturally, I'm going to say use ours. But there's lots out there. So, your
You
Hargreaves.
can say the name if you like.
Yeah, I was about to say, what's yours
You
called?
take your moments to plug it. We won't give you money, so you can take it there.
I'm allowed to do the plugging. So retirement line, so go on retirement line, and they'll like compare the market for annuities. So they'll go through everyone on the open market, and they'll just list it in highest income order to lowest income order. And like I said earlier, there's a big difference. So on average, about 15% between the bottom offering and the highest offering. So there's an awful lot of people, roughly 40% in the last sort of FCA data shows that they went with their existing pension provider. So they got their pack in the post and they said, would you like an annuity from us? And sign here. And they say, sign here. And they're lovely. Thank you ever so much. But they could miss out now on quite a lot of income.
It's like going with your bank for a mortgage.
Yeah.
Like you shop around because the rates can vary quite a lot.
Yeah, I mean, inertia is a powerful tool, right?
Yeah.
But it could cost you, like I say, with an annuity, it's not just 1 year. Every year for the rest of your life, you're missing out on that income. So it's really worthwhile shopping around.
Can people shop around without the help of a broker?
They can. So you can go on Money Helper, the PensionWise service. You can go on there. You can't transact through there, but they have got a whole of open market portal. So you can do some shopping around and get an idea of what's going on.
So a little quiz for you. Do you know what any of these things mean? ISO 27001, SOC 2, the EU AI Act, or DORA? If not, no worries, but if you do, it probably means you work for a company that cares about security and compliance. If you're a growing business today, you have to prove that you comply with security and privacy frameworks like these, and GDPR, so that you can land big deals and grow your business. But the problem is, achieving and then maintaining compliance with these frameworks is time-consuming and complicated. This is where our partner Vanta can help your business. Vanta automates up to 90% of the work and 85% of the associated costs for in-demand frameworks. So if you want to prove that you're secure and compliant, check out Vanta. You can also get $1,000 off Vanta if you go to vanta.com/makingmoney. So that's vanta.com/makingmoney for $1,000 off, and there's a link in the description for you.
So when I bought life insurance, what became clear was that it's not just about price, it's about the T's and C's to make sure that these things actually pay out. So more like the life, he's dead, they pay out. But things like critical illness and other covers that are a bit more nuanced, and you might want certain levels of cover or certain circumstances. And I did find a broker useful in that setting because they have that experience. Is it the same with an annuity, or could someone theoretically go, I just want something to pay X amount, let's go find the best price for that?
So I would say it's a lot more of an equal playing field, just purely because all the protections are the same, all the annuity options are the same. I would say is people would probably benefit by speaking to an annuity broker to make sure they've understood the options correctly and it matches their wants and needs. And the other point is that health and lifestyle point. I think it's so important because we don't do it every day, right? So you're going to put in any medication or this is my occupation, it doesn't matter, I'll just put in engineer. On our system, if you're going to put in engineer, there's about 75 different engineers and they all impact life expectancy. So it really matters to have that conversation and make sure you've got it right. It costs you nothing to get the quotes or have the conversation with an annuity broker. So go and have that conversation and get the quotes, even if it's just as a sound check. And I think that's where annuities are really useful. They're a really powerful informational tool. So if you're going on your pension income journey, why not get an annuity quote matched to your life expectancy, do the calculation yourself and think how long is this annuity provider think I'm going to live for, and know that at least you can get that amount of income guaranteed for the rest of your life. Even if you don't go on to purchase an annuity at that point in time, you've got it as a baseline if nothing else.
That prediction is terrifying.
It really is. It really is.
I would take it personally and really want to beat it.
But it's kind of a win-win. You're like, okay, if they think you're going to live forever, you're like, well, at least I'm going to live for a long time. You're like, okay, cool, I'm going to live for ages. And if they're like, you're dead next year, you're like, I'll show you. And then you're just like, I'm going to get my money out. So like every day you wake up, you're like, got another day out of them. Yes, come on, I'm getting closer to my money.
God, remember me?
Remember, I'm still here. I'm still here. Send them a Christmas card every year. Get my money ready. I'm still here.
Merry Christmas, you paid for this card. I think it's a really good point, but there's some research, it's going to be quite old research, close to when I was born, but I think it was Legal and General said that something like 92% of all their annuities that were started in 1997, I think this research was early 2000s, 20 odd years basically, you're looking at the research, but still paying out. So a lot of people they were winning that gamble. Because when you think about medical enhancement, especially things like heart conditions, what we can do now with heart conditions that we can do 20, 25 years ago is extreme. So there's a lot of annuity providers that are keeping up to date with medical enhancements are going, right, do I need to factor this in? Are we going to solve some of these or treat some of these conditions?
About AI and the ability to, like, you know, do mass data on like medical problems.
Yeah.
Like the protein thing, you know, the protein folding or whatever it was. So they just couldn't figure it out, and then they run it through AI, and it's like, there you go.
There you go, solved it.
Yeah, so these kind of things have massive medical implications. I bet annuity brokers are shitting themselves over that stuff, right?
Yeah, I think if you're an underwriter, you must be looking at every AI platform all the time and just make sure that my calculations...
ChatGPT, like asking chat, how long is this guy going to live?
But that might be a good idea to get a deferred, like to buy a deferred annuity when you buy it early, because if they're about to find a cure for cancer in like 10 years and you do it now, and you know, so like all these like medical advances, if you get in before they come out, it could affect you.
That's it, yeah, exactly. But it's
a gamble again.
It's that great unknown. It's like, this is the thing, I think annuities, like I say, on one hand you go known quantity, secure, but really it's a roulette wheel and you don't exactly know if you're going to be on red or black. It's really a 50-50. There's no other option.
Yeah, okay. And so you mentioned the fees there. You said that you think a normal fee for a broker is about 1 to 1.5%, and they range up to 5 to 6%, and that's a real red flag for you, that end of the market.
Yeah, I'd say so 1% to 3%, because it depends on the product.
Yeah.
So if there's underwriting involved and you've gone through that health and lifestyle, you're closer to the 3% mark. If you're going for a standard annuity, conventional annuity, i.e. there's not an awful lot of information involved, it's closer to the 1% mark. So don't be surprised if you see something in that range. If someone's charging close to 5% plus, what are they doing for that amount of money? I mean, that's an awful lot of money to take off someone for a one-off single transaction. Don't get me wrong, it's a massive decision, so it's a huge decision to make. So make sure you've had that 5% worth of support. That's what I would say.
Yeah, because a person that we've had on the podcast and that we respect, Roman, he was critical of the fees within the industry in terms of, he said they were quite opaque, hard to understand.
Yeah.
Is that still the case? And we've spoken there about broker fees. Are there other fees that people need to be aware of?
Yeah, so with annuities, they're quite fortunate because they are that single transaction. So there's no ongoing fees. There's nothing else to factor in. You're getting the income that's fixed. So really look at that broker fee or the advice fee. That's the important thing with annuities. If you're looking at partial annuitization and drawdown and bits and pieces, really get on top of those ongoing fees, those platform fees, because they all add up and they really do make a difference.
What do you mean a partial annuitization?
So if you're using part of your pension pot to buy an annuity and you're using, say, £50,000 to purchase an annuity and the other £50,000 in drawdown, be really careful with that drawdown ongoing charges, because like I say, they do all chip away and they all add up. And if the investment performance isn't where you need it to be, your fund value is only going to erode quicker because of the fees involved.
Why do you think the annuity industry then, if it is just transactional, the one transaction, it does what it says on the tin, why has it had such a bad reputation at points?
So I think it had bad reputation for a couple of reasons. One is fees were awful. The rates were awful. So the rates were really bad at that time.
Because of low interest rates?
Low interest rates, low inflationary environment. It wasn't great. If, like I say, 65, you're getting less than 5% a year. You have to live for a long time to see your original investment return to you. So it doesn't feel like they're offering great value for money at that period in time. The other reason I think that they weren't doing so great is because people were forced into it. And I think if you feel like you're being forced into a product, it's not nice. And that's where Pension Freedoms has helped. But I still think that we've got a generation or two of people that basically say, actually, George Osborne said that they're bad. Well, he didn't say they're bad, he just said we're not forcing you to purchase them anymore. I think that the third reason will be how inflexible they are. You're buying an annuity, whereas with drawdown, you're entering drawdown. So you're going to entering drawdown, you'll still have access to your pension pot. There's still flexibility there. It's still your money. Whereas with an annuity, you haven't. You've purchased it. You've handed over a pot of money and you're now getting an income for it. It's much more, like I say, it's transactional. And that feels a little bit out of your control. On one hand, you've got the control because you're getting the annual income, but you spent it. It's a purchase.
Yeah, I kind of like the idea though of a little bit of guarantee. You know, what do you think?
I need some guarantees in my life, mate. I'm waiting for the price of Bitcoin to go up. I'm doing all sorts of things, but yeah, I would have something that giving you a fixed return every year is like, it'd be quite like a comforting blanket, especially in your retirement when you can't go back to work.
Yeah, and like I say, if you go right now, so if you do it when you're about 75, 10% annuity rate is standard. I mean, where else are you going to get 10% guaranteed income? It's quite a good.
Yeah, the rates are high because you consider that most like common advice would be 4%. You can draw 4% of a pot's value and it will sustain you. And obviously that's working off retirement age. But when you're saying 7%, that's why I was surprised that the rates were that high.
Yeah.
Even low rates were 5%, you were saying. So it's still quite a fair bit higher than the 4% rule that people throw around from like a withdrawal rate.
Yeah, that's it. But that old school thinking of 4%, I think it's closer to 2.5%, 3% I've seen nowadays actually. So to do that but maintain the pot, that worked really well in the old inheritance tax rules, and there's still some uncertainty around this because your pension would want to be the last thing you touch because of how the tax was in that position. 2027, although we need clarification on the rules, actually your pension's brought into that inheritance tax wrapper and into that piece. So all of a sudden, accessing your pension early and buying something like an annuity feels a lot more appealing than it was even a year ago. I would like to know that I've got some certainty there. Yeah. So I would do my retirement checklist and just go, okay, these are the things I have to pay. I have to pay a council tax. I have to pay whatever it is. This is how much I need for food and basic living. Now, if I know that the state pension is guaranteed-ish at this moment in time, and an annuity can top that up and get me to the rest, that's an awful lot of peace of mind. And then the rest of it, you can have that investment exposure through drawdown, and you can be a little bit more riskier than you would have otherwise been if you were relying on that income to live on.
Yeah.
So you wrote recently that 2025 was going to be a significant year of change and adaptation for the pension industry. Is this because of the IHT rules or?
Yeah, it is. And also some of the digital enhancements coming down the road as well. What we're seeing is a lot more of the pension, from a pension income point of view, a lot more of these frameworks coming in. So actually, people will look at, we think that you have a default journey of drawdown for the first 10 years and then annuity for the rest of your life. And that's the general direction of travel the industry is traveling in. And again, that's because of that risk of running out of money in later life. And that's the way that people are, broadly speaking, thinking about it. And cognitive decline. So people thinking actually you're more mentally aware and able to make these investment and financial decisions earlier, but once you get to 80, we're not so sure. So we're going to annuitize you. Something a little bit uncomfortable about it. It won't work for everyone, but it's some solid thinking. So I think that's going to come along. The other thing is, at the moment, say I've got a pension with Aviva, for argument's sake. I go to Aviva, they're going to give me my options, all on my Aviva pension pot. I've then got another pension with Legal and General. They're only going to talk to me about my options with my Legal and General pension pot. I've got one Standard Life, etc., etc. What we're going to see now is a lot more consistency between the options, and where something like Pensions Dashboard can really change something is go, these are all of your pensions, and you can make a decision on a much larger sum of money together, rather than thinking about it as, oh, well, Legal and General wrote to me today, so I'm going to access my pension.
Yeah, like, I quite liked Jeremy Hunt's kind of pot for life. You know, everyone has one, almost like a SIP product that follows them around forever. It'd be even better if they started at child age. So, like a junior SIP auto. Adults could pay in maybe some tax benefits, and then you get it at 18 and you auto enroll and you carry it around. Because the people have like more control, but would they have more buying power if they had all of their pots together in that sense?
I think so. And I think it also sharpens the mind as well, to be honest, because I think there's some stats out there that I've seen quite a few times. Basically, people spend longer picking where they're going on holiday than they do deciding how they're going to spend their or access their pension, which is mad. But that's because they're seeing pots of 10,000, 12,000. I think on average, people have like 8, 9 different pensions knocking around now. And they're making these smaller decisions broken down. Whereas if you see them all together and it's 250,000, you go, oh, well, what am I going to do with this £250,000 rather than what am I going to do with this £20,000 over here? It really changes the mindset quite substantially.
Are you seeing larger pension pots now with the boomer generation coming in?
Yeah, I mean, just with annuity rates. So 2020, average fund value at retirement line we saw was about £70,000 for a purchase. Last couple of years, it's over 125,000.
Is it because they're more attractive?
Yeah.
So you're just seeing more people come to the table?
It's these people, high net worth people, so people with £500,000 plus, will then start doing what I was saying earlier, using a portion of their pot to lock in at these higher rates. And I think that's the crying shame, isn't it, about the
That's why I asked if I could get one now.
Yeah,
honestly, we're interested in the higher rates.
The rates are pretty good right now.
Yeah, that's it. Take full advantage. You were an ex-footballer, right?
Yeah. Yeah, you smoke 50 a day.
Yeah. But no.
Oh, that's orange.
Get an enhanced annuity now. But no, they're timeless. They're always going to be there. I don't think we're ever going to see a day where annuities won't be sold. I think they are always going to have their place in the market. It's just, when is the right time? When does the rate match with the wants and needs? And that's why I think it's so important to always keep checking in and always getting that annuity rate. Like I say, getting an annuity quote costs you nothing. And there's so much to gain from it informationally wise. So just get quotes.
Better than seeing a palm reader. Like you get the annuity industry to tell you when you're going to die. I'd rather that. Do you know what I mean?
Do you remember back in, I don't know, you guys are probably younger than me, but back in the 90s, it was a thing, like, to go and check when you're going to die.
Yeah, when you're going to die.com or whatever.
Yeah.
It was like a deathclock.com
Yeah,
as well.
deathclock.
It's like counting down your minutes.
Yeah, it's just that you'll die here. I assume it wasn't ONS data, but like, I used to do it younger, so I'm doing it a little bit older and actually getting it done by professionals.
That's what I mean.
Seems like a stand bet.
Yeah. Would they? Can you ask them why? Can you say like why do you think
why
I'm
do you
going
think
to
I'm
die?
dying?
In that?
I think you can probably ask the question. I haven't had too many people ask the question. But
I'd like to know, because if they were like, well, people in your age group who are engineers, they tend to have this. You could be like, well, okay, well, let's not do that.
I mean, some of it's like fairly common sense stuff. So if you've got a more manual job, your body's going to go through a bit more stress and strains and all this sort of side of things. But yeah, I think you can always ask the question. I mean, I don't think I'm that sexy. Obviously, annuities are sexy, but to go through mortality rates with an actuary, I think, is another level of sexiness. Probably not for the podcast.
We're going to do it. We'll do it here. To be honest, we'll do it. Now, my mum used to work in the insurance industry in the past, and she always used to tell me when I was a kid, as you do, butchers have higher costs because they eat so much red meat.
Yeah.
She was like, like if someone says they're a butcher, it would whack up the costs because they just were eating so much. They would suffer from more like heart disease or whatever. So it's like these kind of things. This is the kind of data that they're leaning on, right? They know that. Yeah.
Postcode's massive. So even postcodes. So like we all know that different areas have different life expectancies. So if you have a couple of properties, I suggest using the one where you.
So just move to the most cracked out area of England and then live there for a year and be like, I live here in the hood. Can I get my annuity, please? 100 grand.
Well, I know in America, the place with like the lowest life expectancy and the highest are separated by one road. Really? And on one side, it's like one of the poorest places, and it's like a really high presence of like fast food diets, and then the other side are a branch of like Christianity where they focus on health and well-being. It's like their religion. So they're like 90 and they're all in the gym and all of this stuff. So it shows like literally a road can separate, decades of life expectancy.
We know that in London for sure. Yeah, you see like one side of the road, council estate, the other side, $1 million houses, and it's just different lives.
I wouldn't want to say the areas, but I've looked at different areas, and thousands of pounds a year difference between just where you live.
Where's the highest? Where's the best place to live if you want to live forever?
Well, live forever.
Well, like live pretty well.
Getting that annuity forever.
I can't give away those secrets.
Infinite annuity.
Live quite a long time.
So South Coast isn't too bad from a longevity point of view. I think it's widely reported that certain places in Glasgow and Blackpool and places like that.
Yeah, I live
Longevity
right
is a
near
little
Blackpool.
bit.
I live in Southport, which is just like, it's just down the road from Blackpool. I literally, you could see, I sent you a pic, Ruth, the producer, I sent her a picture of Blackpool the other day from my beach. I was like, oh, there's Blackpool. So yeah, cost me 20 years, that fucking view. Great. So, but I could be like, oh, I live right near Blackpool, here's a picture. And they'd be like, oh, well, yeah, whack his rate up.
Yeah, exactly. If you were living in Blackpool, you would get a better rate. If you are, every other situation was identical to someone who lived in Cambridge, you would get a higher income.
And that's not really because of the location, it's because of the demographics of the location
That's
in
correct,
terms of like the incomes and the poverty and stuff. It's not because, oh, there's more smog there that's killing people.
No.
Because surely inner city London, I stand on Southport Beach and the air is clear.
Yeah.
In inner city London, I can feel the thickness of the air when I breathe it, you know?
It's not that, but it's not like Mexico City where you can see the smog.
I don't know. No, but I can
Can you
tell.
still see us viewers from the fog? Is it
Yeah, it's just congested, and I can, you can feel it in the air. So what I'm saying is, surely people would an inner city region, and are there any areas where the actual the place is killing the people? Not
not that I'm aware of, other than that's a fantastic script for the next horror movie. It is the city that's killing you.
Yeah, and it would be London. No, okay. And I'm interested because you said the average is about 120k. Do you get people with millions of pounds buying annuities?
Yeah. So we had one this year where it was only partial, but it was close to 5-6 million.
Partial.
Yeah.
Coming in with a partial 5 million.
5, 6
a 7%.
Doing all right.
Yeah. So I mean that'd be like 350 grand a year or something.
Yeah.
Yeah,
A bit more.
that's all right, isn't it?
You do okay with that.
Yeah,
You do
partial
okay.
as well.
Partial.
Just to keep the
And then
lights on.
Then give the missus a 0.1% in case you
Yeah.
pass away. She's like, what?
She's all right.
She'll be all right. She's got the house. Give her 0.1%.
I feel like they probably haven't had the requirement to do the expenditure bit and go, I'm just covering my essentials.
Yeah. But I mean, especially if you've got a lot of money, the guarantee of income is so high. 35 grand a month or 30 grand a month, you're probably like, why not?
It's so funny with like the mentality. So there's a lot of people who go, okay, annuities are for people who need that security. So they don't have any other investments. So they really need that security. There's some financial advisors out there who go, okay, the annuities are risky products. I can watch our investments and I'm secure with our investments, but your risky products, the annuity.
They don't want to lose the assets under management.
Yeah.
Because they know if they give that to an annuity provider, they can't take 1% off it.
There are some advisors with that thinking.
And I think if you've got 10 million quid and you say you'll give me 7% a year for life on that inflation linked, I'm going to struggle to get that real return on the investment portfolio potentially. Yeah. In terms of, the markets might kick out 9% a year nominal, but in real, it might be 5-6%. And there's an uncertainty of what happens if the markets decline for 5 to 10 years during my retirement, and I've only got 20 of them. Whereas you're going, we'll basically give you a good rate of return for the whole period.
For me, ideal scenario, not everyone can do it, but ideal scenario is, like I said, is you get a little bit of an annuity, covers you for an initial period of time. You then go in for some investment exposure. And you can do it in bits. There's no limit on the amount of annuities you can purchase. So
you could do one for 5 years from like 75 to 80 and then buy another one when you're 80 or 81.
Yeah. That fixed term annuity, a lot of people who purchase one and then they get their maturity amount, they get their, 80 odd thousand, whatever I said earlier, they then go into another fixed term annuity. That's what an awful lot of people do. They keep rolling over because they like the known quantity. They like the fact they know exactly what they're going to get at the end of the term. And they're just not ready to fully lock it away with an annuity provider. So that's why that product can be really quite useful for people.
And how do you think people should think about them? What's the one bit of advice that you would give to someone? It's like, okay, maybe this is something that I would like.
Yeah, with an annuity, shop around. So make sure that you go on the whole of the open market. Like I say, it's a big difference between the bottom provider and the top providers. The other thing is that health and lifestyle is so, so important. Just to give you an idea, those two factors alone, as an average across 2024, made a difference of about 22% on annual income just from doing those two things. So there's huge value in just doing those two things. The other thing is make sure you know what you want from your annuity. Is it for you? Is there a concern of making sure you get at least what you invested back out of it? And is it a requirement that is your spouse, partner needing this income in the event of your death? Because you do need to think of these things.
So be honest.
Yeah.
Shop around and think about, not just yourself, but the people around you. And also, do you need to get everything back that you've put in? And
That's it. I think they're the key things to consider. But like I say, no one anymore saying you must go for this product. It's not all or nothing. You can buy a little bit, you can buy none of it, but keep it in touch. Keep checking in with annuity rates. Because like I say, people that purchased an annuity in 2020, people purchased an annuity in 2020, now getting about £2,000 a year less than if they were purchasing one today. There's no way of timing the market, but if you get a quote that's right for you and feels right, why not?
Yeah. And I guess you could look at historical rates and go, these rates today are low compared to the average. So I'm going to buy a small annuity today to see me out. And, in periods where rates are high, maybe like now, high, I mean, they're more normal, aren't they, than they are high. But you might go, okay, well, this is the time to buy a big one.
That's it.
You don't need to, it's not one and done. The only decision you ever make.
No.
To follow on to that, can you buy more than one annuity at one time?
Yes.
So like you've got one now, the rates are okay, then the rates get better. You can buy another one?
Yeah, correct. Yeah.
Awesome.
I'd like to just have one every day, like payment plan every day.
Dollar cost averaging.
Every day.
Paying you every day.
I just want that cash in my bank account every day. And then I know that I can blow this today.
Do they pay you once a year, or can you do it like every 6 months, every month?
Yeah. So it's typically monthly. But you can do monthly, quarterly.
But not daily.
Annually. Not daily. Not daily.
Just want to see the money coming in.
I just take out 31 annuities and then just have them rolling in. They just wake up every day and be like, what have I got today? So good.
31 annuities.
Yeah. All right. Perfect, mate. Thank you so much.
I'll be honest, I did very minimal prep for that episode because I was like, annuities is going to be super boring. I don't know what it is. After speaking to Mark, I'm super excited. I'm going to get like 12 annuities. I think it's great. Forget the property market because it's too much stress for me. Annuity, guaranteed return. I love it. There are no guarantees in life except for death, tax, and annuities. I like it.
It doesn't surprise me that nothing about a topic and your answer is, I'm not going to prep for that at all because that'll help. But anyway, if you want to get in touch with Mark, we'll leave his details below. But I do agree, mate. That was pretty eye-opening for me as well.